Welcome back, everybody. I hope you had a good break, and now we are going to continue on with the balance sheet. And first we're going to jump into the inventory area. Now, inventory is very important to your financial statements if you sell a product. So let's go ahead and jump into that section. So now, inventory. Now, inventory is one of those things that is very key that you understand how everything flows through there. Now, the very first thing, obviously, you're going to want to do this similar to the accounts receivable in that you want to tie out your inventory reports to your control account. However, you're going to do more steps in this area than you would in your accounts receivable. Now, the first step you're going to do is physical counts. If you have inventory, you need to do a physical count. I would suggest every month until you've got a process in place that you can do periodic reports. But you do a physical count. You have a listing, print out a listing out of your software. It says, here's a listing of all the inventory. Take out the amounts that are currently showing in the system. So you'll have count sheets that just list the raw material item and whatever, maybe the SKU number, but doesn't list anything else. The reason why you want to do that is if you do an inventory count and you give an inventory count sheet to a person that already has a number on there, some people are very lazy and they'll just check, yep, that's there, yep, that's there. They don't want to count, 150 bottles of honey or something like that. So don't have the count on the sheets. It's just a listing of here's the raw material and then a space for them to write in what the count is. They go and do the count, and then you reconcile that count to what's in your system, because then you want to say, okay, the physical count says X of this product, but says there's 10 of this product, but your accounting system says there's 15. That's when you start investigating variances, and that's an inventory variance that you want to investigate and say, okay, why is this coming through like this? I'm showing more. That's not what I want to see. So that's the first thing you want to do, is go through and make sure your physical counts, just the number of items, agrees to what you're physically showing to what's shown in the books. Reason being is, one, it'll help you catch any kind of data input errors. Two, it'll help catch maybe there was a cell that just didn't release, the accountant didn't release the inventory item. Again, remember, when you have inventory, that's a cost that's sitting on the balance sheet and it hasn't been hit the income statement. So if, let's say, go back to that example where your books are saying there's 5 extra of a product in inventory when you really don't have that, and let's just say it was a sale that didn't get released, you look at your net income. Well, the sale on that particular item is probably hitting the income statement, but the expense hasn't transferred over to the income statement. So you could have a skewed net income, which again could drastically affect a decision you're going to make. So that's why we do physical counts, and they're very important to do. Now, the next item, valuation. How are you valuing your inventory? So you're going to hear the terms LIFO, FIFO, and there's some other ones, but those are the two big ones. LIFO means last in, first out, and FIFO is first in, first out. So let's do the LIFO one first, last in, first out. So what that says is, if you're ordering products, and we're talking raw material here, it's saying that whatever the last item that you purchased is going to be the first item you sell. So in other words, that's something you would do if it's a homogeneous item and it's like a bulk container. Let's just say you've got a bulk container of bolts and you get another shipment of bolts in and you just dump it on top. Well, a LIFO system would make sense, because you're saying, okay, all that stuff that I just got in, that's going to be the first to go out. Well, that's how you're valuing that inventory. So you're going to value everything. You're saying, okay, if I had a shipment in January and I had a shipment in March, and let's say that shipment in January was $65,000. A shipment in March, let's say that's $80,000. Well, you're going to get rid of the $80,000 cost first and then dwindle down the $65,000 cost, because you're getting rid of the stuff, the last in, the stuff that came in last, that's to go. So you're reducing that cost. The other way is the FIFO, the exact opposite. You're saying that first item that came in, it's sitting on the shelf collecting dust, that's going to be the first item to go from a cost standpoint. And so that's very important that you understand how you're valuing your inventory and what is the best practice in your industry and what your product is. So if you have a food product, you're probably going to use LIFO, because I'm guessing all that stuff is going to, well, let me rephrase that. You're going to be using FIFO because you're probably going to try to use up the old stuff first, because if you don't, you're going to end up throwing it away because of spoilage. And on the cost side of this, so we're going to take a look at what a inventory, what a valuation would look like on this. But on the cost side, you get that invoice in, and whatever the product costs are on that, that's what you're going to assign to it. Now, there is some software, some ability to assign a specific cost to a specific item. When it goes out, that's what the cost is getting released. However, if you purchase bulk items, large panels of steel, large panels of aluminum, maybe some insulation, whatever you're building, you need to come up with an actual value on that inventory. So it's very important you understand that. So let's go back. You're going to do a physical count, and then whatever's left in your system, you're going to say, okay, these items, here is the cost per item as it is today. And so then that translates to your inventory. Now, that's just the raw material side. So you see down here, we're talking about the makeup of inventory. Inventory is made up of raw material, work in process, and finished goods. So these two items right here are predominantly going to be just the raw material, just the actual stuff that you purchased that you're going to assemble and sell to the general public. Now, you need to know when you take ownership of inventory. Now, this may sound a little odd, but if you're ordering stuff from pretty much anywhere, but usually overseas, if you're ordering product from Taiwan, you need to understand what the terms are. So if you have terms of FOB, free on board, shipping point, or FOB destination, if it's FOB shipping point, what that means is the second they take that product, whatever you ordered, and they put it on the ship, that inventory has now transferred over to you ownership-wise, even though it's still half a world away, and it's going to have to go across the ocean and then cross the through customs and across a whole bunch of interstates to get to you. You technically have ownership, so you have to record it in your inventory, even though you don't physically have it yet. So again, that could be a variance on your variance report between your physical count and then what you're showing. So that's very important you understand, based on the terms of what you ordered, when did you take possession. Now, a side note on this, if you do take possession at the shipping point, i.e. they drop it off on the ship and it's going to get on the ship and you now own it, you need to make sure you have insurance on that. So very, very important, because it's transferred ownership. That ship pulls out in the middle of the Atlantic and sinks, that was yours. And if you don't have it insured, that is all your money literally down the drain. So you have to make sure you get insurance on that, and that's what this insurance part. You also want to make sure your insurance covers your inventory in your warehouse or wherever you're located, because if there's a fire, sometimes insurance policies may only cover the structure, but they might not cover what's inside. So you need to make sure your insurance policy covers your inventory inside the warehouse or building. Okay, now work in process and finished goods. Now, work in process is literally you're building your widget, but it's not quite ready to be put into the box and sold to the customer. You still have to slap on some stickers or put some screws in, or whatever the process is. That is technically still inventory. Now, these three areas, work in process, you only are concerned about work in process when you're doing your year-end inventory counts or you're submitting financials to some sort of entity such as a bank. So don't get too worked up on doing the count on work process, but just understand what that is. When you value work in process, that gets a little tricky, because at what point in the process is it at? How much labor is involved? How much the material have you already used? It gets kind of tricky, so just keep that in mind. So the next item, finished goods. Now, if you're assembling a product, there is a concept, it's called full absorption. It's actually called full absorption accounting. And what that says is all the costs that were necessary, both direct and indirect, should be allocated to the cost, i.e. to the finished goods. So the easiest item within finished goods is going to be your raw material. Whatever you paid to get that piece of insulation or those screws, that you already know that. So that is the easy part of determining what your finished good inventory is. The next item is direct labor. Now, when you're having people assemble your product or put it together or manufacture it, the people who are actually working on putting that project together, that's going to be your direct labor. And you can do an analysis as to what is the total hours in there. How do I allocate that cost? Once you figure out how many hours it takes to produce a widget, or 10 widgets, or however you want to do it, per hour, then you can then allocate the direct labor hour to that product. Now, the hard item, and the item that many people forget, is overhead. So your building that you're using to do the production, well, there's depreciation expense there. Well, that warehouse where everybody's standing, there's utilities there. The back room where they do some of the work to make sure everything's proper and repackaged, that's part of the cost. That's an overhead cost. The easiest way to do an overhead cost is first find out all the indirect costs that are related to that product. So in other words, that product didn't just get assembled. You didn't just take direct labor in that product and put it together. You had to pay rent on the building. You had maybe depreciation expense if you own the building. You had utilities. You had all those items, benefits to the workers. All those items are related to producing that product, but they aren't directly related to that product that's sitting there on the desk. That's your indirect cost, or usually considered overhead. You need to determine how you should allocate it. A lot of times what happens is people say, okay, here is my indirect overhead, and I'm going to allocate it based on direct labor hours to total labor hours. That's a ratio you can use, or you can use costs or sales, or however you want to allocate it. A lot of times what I've seen is companies will determine what their overhead is for the year. Let's say they did it for 2018. They said, okay, here was our total overhead for the year. That's 500,000, and we had direct labor hours of 20,000 direct labor hours, and there was total of 43,000 total hours. Well, then they can take that percent and say, okay, we're going to take that percentage of the labor hours, whatever that percent comes out to be, and divide it into the total overhead, and say, okay, of the total direct labor hours, here is what the overhead labor hour rate is, and then they use that rate for the next year, for in this case 2019. So you don't go back and recalculate it unless you have something weird come up. You calculate that, and then you allocate that to the cost. So that's going to be cost of the finished goods. So that's what full absorption is that saying, here are all these costs, we need to put it in here. Now, this concept is very important to understand, and I'm going to do a separate monthly training on cost accounting, and we'll go through this in more detail, and we'll walk through that process. But it's important that you understand that full absorption costing is key to understanding the cost of your product, because if we don't know what the true cost of your product is, we can't do a break even. If we can't do a break even, we don't know what we should be selling this for, or if it's just one of those, with the way the market is, there's no way we're going to make profit on this particular product, so you can just pull the plug now and not, bleed cash all over the place. So now let's go into the inventory ratios template. So here we have the inventory ratios. Now, like I said before, ratios are great tools because they allow you to analyze your company and compare it to any other company regardless of the size. And so that's why you always want to have ratios developed, one, in your company to compare to other companies, but two, it also helps you identify really quickly what actions you need to take within your business. Now, in this particular situation, we're just looking at inventory. And this first ratio that we have up here is called days in inventory, or days sales in inventory. You sometimes hear it referred to as that as well. But what this does is it says, of the balance that you have in your inventory, how many more days can you produce your product based on how the costs are going? And do you need to be concerned about ordering, or do you have too much inventory? So, like I said before, in this situation, I just have two columns here for comparative purposes. And in this particular column, it's saying in this period there's 122 days of inventory sitting there, and in this one it's saying there's 15 days of inventory. And let's go ahead and let's put some dates in here so it makes it a little easier. So let's say this is 2018, and let's just say this is January of 2019. So in this situation in 2018 we had 122 days of inventory sitting there, and then at the end of January we only had 15 days. So that needs to tell us that either if 122 days, if we only sell, let's say, maybe you sell 20 products a month, or that type situation, or maybe you sell 3 a day. 122 days of inventory, that's cash that you have sitting in inventory. So do you really need to have that much inventory? And so that's something, every business is going to be unique on how many sales you have as to how much inventory you need to have. And we're going to go, in this next item, we're going to go over the reorder point. We'll go over on how to determine how much when you should reorder. But in this situation, this formula is valuable, and it just gives you an idea as to how much inventory do you really have on hand. Because the last thing anybody wants to do is have sales, but you have no inventory to be able to fulfill those sales. Because as we know, if that happens, then you have that vicious cycle of then you start losing sales, and then when you do get the inventory, and then you've lost the sales, and then you have reputation issues, and it's just this snowball effect. So again, this is very powerful and pretty simplistic formula. The way this formula works is you're saying how much cost of sales do we have in a period, whether it's 30 days or the full year, and we say, okay, of those sales, how many days are in there? So we've got 30 days of that 100,000, which if you take 30 into 100,000, you're going to get 3,333. And then you say, okay, so per day I incur $3,000, $3,300 of expense in January 2019, and I have 50,000 sitting in inventory. So you take that 3,000, divide it into the 50,000, and you come up with, in this case, 15. Always round your days in inventory to the nearest whole. Don't do the 0.3, 0.4. That's not going to tell you anything. So always round up. In this case, it's saying approximately 15 days worth of inventory in here. Now again, we have to look and see, is that reasonable for our industry or what we're working on. Now the next item, this is a very valuable tool for those of you who do manufacturing and you manufacture or sell a product, and it's called Reorder Point. Now what Reorder Point is it helps you calculate, if I get to X amount of units, I have to now reorder. You've heard the term of lean inventory or just-in-time inventory, where you get the inventory in just in time. Well, you need to know what your reorder point is in order to truly run just-in-time inventory. And what reorder point does is, first we find out what the lead time demand is, plus in case the safety stock will get us to the reorder point. So first item, lead time demand. What that is first you want to calculate of your product, how much do you sell in a day? Do you sell 10, 15, 20? What's your average daily sales of your product or usage? In other words, if you're producing them and they're becoming finished goods, and then they're going to go off in another point in time, how much usage do you use in a day. So a lot of times sales is easier, but if you need to, you can also use how much do I use in a day, because you may have a raw material that you use on a product, but that's just the first part of that product, and then that product is going to go to maybe a fabrication shop or somewhere else, but you still need to know how much of that product you use in a day. Next, you want to calculate the numbers of days it takes for you to reorder and get the product at your door. So in other words, if you have half-inch bolts and they're special half-inch bolts, and let's say they're titanium, and so you have to order them from a special manufacturer on them, how long does it take you from literally sitting down at your computer, filling out the order, hitting send, whatever day you do that, that's when you start your count. So I clicked and I ordered another 10,000 bolts, and I hit send, and then they came back and said they confirmed it. How long is it from when you click that button to when that package physically arrives at your door? That's the number of days you need to calculate it. So is it 10, 20, 30? If it's coming from overseas, it's probably going to be a lot longer than that, because it's got to go, be loaded at a dock, then unload at another dock, then go through customs, and then put on a truck, and then deliver to you. So calculate all that time that that takes from literally clicking the button to when it arrives at your door. Then you want to know, you're going to take those two numbers, the daily usage, average daily usage or daily sales of the product, and times it by the days it takes from sitting down to order to when it shows up, and that's going to be your lead time demand. Now, safety stock. Now what safety stock does is, in lead time demand, we're calculating, okay, here's kind of what it averages, but what if there's a snowstorm, or there's some sort of issue with a port gets closed for whatever reason, natural disaster, and your product gets delayed coming to you, or your supplier has a delay in their supply chain and the product gets delayed coming to you. You want to have a safety stock in place, because if you're calculating lead time of it takes 25 days and we're at 30, day 30, and it's still not here, you need to have enough in stock to prevent any kind of issues. And so what safety stock does is it calculates that by saying, what is, first you're going to calculate the maximum number of days it takes for the product to arrive. So whatever the worst case scenario that you've came across in sitting down, clicking the button, and it getting to your door, if the worst case was it took 60 days versus 25 days or something of that nature, that's the number you want to use. Then you want to say, okay, how much have I used of the product in a day? What's the maximum number I've used? Historically I've used 5, but the maximum I've ever done in a day was 10. So then that's the number you want to use. Take those two numbers, multiply them together. Now you take that, the sum of the product of those two numbers that you just multiplied together, less the lead time demand that you just calculated up here, and that difference will be our safety stock. So in other words, we're calculating what is the worst case scenario, what is the average case scenario, and what's that gap between those two, so that we have that in place. So that is what should be considered your safety stock. So in other words, if it comes in, it normally comes in, should be here at day 25, but it doesn't get here until day 30, you've got enough product on hand to compensate while you're waiting for the new product to come in. And so let's go through this formula real quick. So lead time demand, again, like we said, average daily, in this case I said sales, but you can add usage, if it's not going right to a sale, and lead time in days. So in this case, we say, that's kind of the average time when I go and I click order and it shows up at my door. It takes 25 days, and I use 5 items every day. So in this case, 5 times 25 is 125. So just lead time demand. If I'm at 125, I need to make sure I'm ordering. Now let's do the next case. What was the worst case scenario that happened to you, where it took forever for the product to show up? Well, in this case, we're saying it was 37 days. For whatever reason, it was a extra 12 days than normal, and the maximum usage I've ever had of that product or sales was 10 in a day. Normally I average 5, but I had one time or a couple times where it was 10 in a day. So take 10 times 37, 10 times 37 will be the max, and then you take that less your on demand will get you to your reorder point. So in this case scenario, when this individual's stock gets down to 370 for this particular product, they need to reorder. Now, we've got a safety stock built in here. Again, we're making sure that we don't completely run out, but we also want to know when do we need to reorder and how long does it take for the demand. So again, this is a very, very valuable tool. What this does is, one, obviously it tells you when you need to reorder products, so you don't have to constantly be keeping an eye on it. You can set criteria within your software that alerts you, hey, this product's down to 371. You're within one product or one usage of having hit the reorder point, so then you can just go ahead and reorder. The other thing that this allows you is, again, inventory is your cash sitting there. So this keeps you from having too much inventory on hand. Now, if you're in a seasonal business, this may not necessarily work as great as you would like. Your safety stock will probably be skewed because, if you're in a business that has a lot of seasonality in the winter months, well, obviously you're going to need to build up your inventory in August, September to cover for the winter months, because one, you're dealing with weather, and two, if it takes forever for the product to come in, you need to build up that inventory. So keep that in mind, is you may have seasonality issues that you have to adjust this reorder point. And the way that gets readjusted is literally it's going to get readjusted in your maximum usage and maximum days. So your maximum usage, if during your seasonal time is instead of, in this case, 10, let's say you use 25, well, then you change that to 25, and that'll help you identify what your safety stock should be. So that is the two biggest formulas or ratios that you want to have in your inventory. And again, this is going to help you manage your company, and in particular manage the cash that you have sitting in your inventory. So now let's go ahead and continue on with the presentation. So now we've come to prepaids. Now this is one of those areas on the balance sheet that usually gets glossed over, ignored, but I just want to touch base on it real quickly so you understand what is going through on the prepaids. Now, prepaids usually is going to be insurance. That's about 90% of the time is it's going to be prepaid insurance. And what it really signifies is it's a cost paid in advance. So if you prepaid the rent on your building, you paid for the first 3 months of rent, that should be a prepaid item on your balance sheet. And the way prepaids work is, using the example of rent, is if I paid, let's say I have $1,000 a month rent, and I paid 3 months of rent in advance, so I'll have $3,000 I paid out. I only take the expense side to the income statement in the period that it is incurred or the expense happens. So in other words, if I paid for January, February, March at the end of December for those 3 months, and it's $1,000 a month, so I paid $3,000. Well, in January, I'll take $1,000 out of prepaid and I'll take it to rent expense. In February, I'll take $1,000 out of prepaid and take it to rent expense. And then March, $1,000 out in the rent expense. So it's a way of allocating the cost to the proper period. The same thing with insurance. A lot of times prepaids is going to be insurance. So a lot of your insurance policies, you have to pay for 6 months or a year of insurance. So when you pay for that 1 year of insurance, you technically will take whatever you paid for it. You'll take that full amount to a prepaid, which is a balance sheet account, and you'll allocate 1/12. If it's a full year, 1/12 of the cost every month to your income statement. So it's just a way of allocating the cost to the proper period, and it's also so you can capitalize it because you haven't quite been provided with the service, but you've paid the money out. Now, current assets. Pretty much all the items we just went through in the first part and this part are current assets. And by definition, a current asset is an asset that can be converted to cash within 1 calendar year. So if you think about your prepaids, usually your prepaid is going to be a year, and if you terminate the policy, you'll get the cash or you'll use it up within a year. Accounts receivable, hopefully you're collecting those within a year. Your inventory, hopefully you're selling that all within a year. Now, the current assets, it's important that you understand that they play a valuable role in the health of your financials and in many of the ratios that we're going to go over, and many of the ratios that you'll end up going over as your business grows and expands. So it's very key that you understand what current assets are and what your total current asset number is. So again, that may seem a little mundane, but that's definitely an important item there. So now we have intangible assets. And intangible assets are made up primarily of goodwill, organization costs, and patent costs. And what intangible assets are is you paid for something, or you, in goodwill's case, you overpaid for something, but you never got a physical asset. You never really received anything, but it is of value to the business. And so it's, under the accounting terms, it's called an intangible asset. So goodwill, again, if you pay for a company, you bought this company and you paid more than what it was valued at, that difference is going to be goodwill that you purchased. Organization costs, again, all your costs for setting up your company, your legal costs, your filing fees, all that stuff to organize a company, that's considered an intangible asset. And then of course patents, if you have a super cool product that you had to go get a patent on, and all the costs for the attorneys and the filings and all that, that's considered part of the patent cost, and that should be capitalized in intangible asset. Most intangible assets you will amortize over the life of the asset, and you'll have to determine what the life is. The only thing that is unique is in goodwill. The accounting rules just recently allowed you to amortize goodwill over 10 years, or you can just what they call consider it for impairment every year. A lot of people, if they paid a lot more money than it was worth for a company, and so they have goodwill, a lot of those people don't want to write off their goodwill. So that's going to be kind of your own decision when you get to that point. It's also key to note that org cost or organization costs are not allowable for tax returns. So if you have it on your balance sheet for your book purposes, if you take it to your tax account, they'll write that off, so you'll have a difference. It's perfectly fine. Just be aware of that. On tax basis, they like to get rid of it. So now, property, plant, and equipment. Obviously, this represents the fixed assets and buildings of your company, and a roll forward schedule. And we're going to go over that in just a second. But the main reason why you need to have a roll forward schedule is so you can track your fixed assets in total and be able to tie them out to your general ledger. I can't tell you how many times that I've did an audit and I looked at a company's fixed assets, their general ledger, and then we end up putting together a roll forward schedule and it doesn't match, and lo and behold, there was stuff going through fixed assets that shouldn't have been there. There was stuff that was sold that was not written off, and so it became quite a bit of an issue. Then, of course, in fixed assets, we have depreciation schedule. Now, there is a lot of softwares out there that will track your fixed assets for you. So remember, you're at your fixed asset when you purchase it and put it in service, it is depreciating, it's losing value, and so you need to take some sort of expense to your income statement. But I highly recommend that you put it in a fixed asset software. And again, there's tons of softwares out there. Some people still like to put them in Excel and track them in Excel, which is fine if you have like 2 or 3 assets. But if you've got 10, 20, 30 assets, don't try to put it in Excel, because what happens in Excel? Somebody goes in and messes up a formula, and if you mess up a formula on a depreciation schedule, it is a nightmare trying to figure out what got messed up. So again, use the software. And then capitalization limit, like we discussed, you want to set up a cap limit that all assets, fixed assets that I buy that are below this set amount, let's say it's $1,500, I'm just going to expense. So like if you get a $1,000 laptop, you don't want to have to, and your cap policy is $1,500, you don't want to have to track that, put it in the depreciation schedule, track the depreciation, track the asset, all that stuff. So set a cap limit that's reasonable, so you're not tracking tiny little assets that come in and out. Now you always want to keep an eye on your assets. Don't hear what I'm not saying. If you've got a laptop, you want to make sure it doesn't walk out the door. But from a cost standpoint, administrative cost standpoint, if it's below your threshold, go ahead and just expense it. So let's go ahead into the roll forward template. So here is a roll forward schedule. Now, let's go over kind of the higher level on this, and then we'll dive down deeper into it. So roll forward schedule is literally that. You take whatever your beginning balance was at the beginning of the year, then you add in your additions, disposals, i.e. you sold the asset, your ending balance, then you drop in your GL balance. Now in this case I don't have a GL balance in here so that you can see that it calculates out. So if I put in under there, you'll see the formula calculates out there. But the important thing is you drop in your GL balance, and this is where you'll be able to trace and verify, oh, something's wrong with my general ledger, or oh, I forgot to add that asset in. So that's a key item there. So beginning balance, this will always be the beginning balance at the beginning of the year. So don't try to do this monthly. Don't do the beginning balance of the beginning of March or April, whatever the beginning of your fiscal year is. That's what you want this balance to be. Then additions. Did you purchase any of these assets during the year? And, yes, no, maybe, and disposals. So that is pretty, self-explanatory as you go through there. Now, accumulated depreciation. Now, again, this is your depreciation that you've accumulated over the prior year, and any addition should tie to your depreciation expense on your general ledger. So when you put this schedule together and you look at your accumulated depreciation, any depreciation expense that's on your P&L will go right here into this number. And the way you tie this number out is you tie that to your depreciation schedule. So the schedule that you're going to get and put in all your assets in, it'll tell you what your ending accumulated depreciation is, because obviously it's going to give you what your depreciation expense number is, but it'll tell you what your accumulated is, and you can tie that number to your depreciation schedule, and then you'll tie that to your general ledger. Now, if you don't have any activity in your fixed assets, which that's not uncommon for our business, and the only activity you have is a depreciation schedule, then this schedule will take you like no time to fill out, but I still recommend you fill it out because it gives you a view as to what the activity is. The other thing that you sometimes have is a transfer. So you had something sitting in vehicles, but it really should have been in equipment. Well, you can go ahead and do a transfer here and get it to flow through, and then you can see it in your general ledger as well. So again, this is really important to have and keep in mind, because ultimately what you're going to do is you're going to end up tying out this balance to your general ledger. So remember, we can't analyze information if it's not complete and accurate. This is another area that we're going to tie out to make sure that, hey, we know our fixed assets are accurate and correct because we tied it out. So if we do have a difference on our balance sheet or a difference somewhere, we know this area is good, so we can move on. So that is the fixed assets. So let's go ahead and take a real quick break. When we come back, we are going to jump into the liabilities section of the balance sheet, and then we're going to start jumping into some of the ratios, because now that once we get through the liabilities, we'll understand the current assets, the current liabilities, and we'll start going into some of these ratios, and so you can see how they're going to flow through and affect your balance sheet. So I will see you in just a second.